The stock market is a lot like the weather. It's constantly changing. Sometimes it's sunny and bright with stocks soaring high. Other times it's cloudy and stormy and stocks take a dip. Right now we're seeing a mix of sun and clouds. There's some uncertainty in the air, but there are also signs of hope and growth. The S&P 500 and Nasdaq, two of the most important stock market indices, have been on a winning streak. This means that overall stock prices are going up. This is good news for investors. But remember, the market is always unpredictable. What goes up can also come down. Now let's talk about China. Let's dive a little deeper into the S&P 500 and Nasdaq. These two indices are often seen as barometers of the overall health of the U.S. economy and the tech sector, respectively. Understanding their movements can give us valuable insights into broader economic trends and investor sentiment. Think of the S&P 500 as a club with 500 of America's biggest companies. These companies span various industries, from technology and healthcare to finance and consumer goods. The index is weighted by market capitalization, meaning that larger companies have a bigger impact on its performance. When the S&P 500 is doing well, it generally means that the U.S. economy is in good shape. This is because the companies in the index are leaders in their respective fields, and their success often reflects broader economic trends. For instance, if consumer spending is up, companies like Amazon and Walmart will likely see their stock prices rise, boosting the S&P 500. The Nasdaq, on the other hand, is like the cool kids table. It's home to many of the world's most innovative and fast-growing tech companies. Unlike the S&P 500, which includes companies from various sectors, the Nasdaq is heavily weighted towards technology and biotech firms. It's full of tech companies, especially those involved in things like computers, software, and the internet. Companies like Apple, Microsoft, and Google are some of the heavyweights in the Nasdaq. These companies are often at the forefront of technological advancements, driving innovation and economic growth. Both the S&P 500 and the Nasdaq have been on a roll lately. This upward momentum has been fueled by a combination of strong corporate earnings, economic recovery, and investor optimism. The performance of these indices is closely watched by investors, analysts, and policymakers alike. They've been setting new records and making investors very happy. Record highs in these indices often lead to increased investor confidence, which can further drive market gains. However, it's important to remember that markets are cyclical and can be influenced by a variety of factors, including economic data, geopolitical events, and changes in monetary policy. This winning streak tells us a couple of things. First, it indicates that investors are feeling optimistic about the future. This optimism is often based on expectations of continued economic growth, strong corporate earnings, and favorable market conditions. First, investors are feeling optimistic about the future. They're seeing signs that the economy is growing and that companies are making money. This positive sentiment can lead to increased investment in stocks, further driving up prices and contributing to the overall market rally. They're seeing signs that the economy is growing and that companies are making money. Strong economic data, such as rising GDP, low unemployment rates, and robust consumer spending, can all contribute to this positive outlook. Additionally, companies that report strong earnings and revenue growth are likely to see their stock prices rise, benefiting the indices they are part of. Second, it shows that certain sectors of the economy are doing exceptionally well. For example, the technology sector has been a major driver of the Nasdaq's performance. Innovations in areas like artificial intelligence, cloud computing, and e-commerce have led to significant growth for many tech companies. For example, the tech sector has been on fire, which is why the Nasdaq has been performing so strongly. Companies like Tesla, Nvidia, and Amazon have seen their stock prices soar, driven by strong demand for their products and services, as well as positive investor sentiment. But remember, what goes up can come down. Market corrections and downturns are a natural part of the economic cycle. Factors such as rising interest rates, inflation, and geopolitical tensions can all lead to market volatility and potential declines in stock prices. It's important to be aware of potential risks and not get too caught up in the excitement. Diversifying your investments, staying informed about market trends, and having a long-term investment strategy can help mitigate risks and ensure that you're prepared for any market fluctuations. Always consult with a financial advisor to make informed decisions that align with your financial goals and risk tolerance. Now let's hop on a plane and fly over to China. China, a land of ancient history and rapid modernization, is not just a country but a significant player on the global stage. China's stock market is like a giant dragon. This dragon, with its immense power and influence, can sway global markets with a single movement. When it roars, the whole world listens. Investors and analysts around the globe keep a close eye on China's market trends and economic policies. Recently, the dragon has been a bit grumpy. Economic indicators have shown signs of slowing growth, causing ripples of concern. China's economy has been slowing down, and this has made investors nervous. The slowdown is not just a local issue, it has far-reaching implications. A slowdown in China can impact the rest of the world because China is a major player in the global economy. Its vast manufacturing sector and consumer market are integral to global supply chains. Think of it like this. China buys a lot of stuff from other countries, like oil, which fuels its industries and transportation networks, copper, which is essential for construction and electronics, and soybeans, a key ingredient in food production. If China's economy slows down, it might buy less stuff. This reduction in demand can lead to a decrease in global trade volumes. This can hurt businesses in other countries that depend on selling to China. It's all connected. Companies that rely on Chinese consumers may see their revenues drop, so when the Chinese market sneezes, the rest of the world might catch a cold. Stock markets in different countries can experience volatility as a result, but don't worry too much. Financial advisors often recommend a diversified portfolio to mitigate such risks. China is aware of these challenges and is taking steps to support its economy. The government has introduced measures to stimulate growth and stabilize the market. These measures include investing in infrastructure projects, promoting technological innovations, and encouraging domestic consumption. Additionally, China is working on strengthening its trade relationships with other countries to ensure a steady flow of goods and services. The Chinese consumer market is also evolving, with a growing middle class that has increasing purchasing power. Global leaders and economists are closely monitoring these developments, understanding that a stable Chinese economy is beneficial for the entire world. While there are challenges ahead, there is also optimism. With the right policies and international cooperation, the ripple effect can be managed. In the interconnected world we live in, collaboration and understanding are key to navigating economic uncertainties. As the sun rises over the global economy, there is hope for a brighter and more stable future. Section 4. What this means for you, investor opportunities and risks. So what does all of this mean for you as an investor? Navigating the financial landscape can be daunting, but understanding the opportunities and risks is crucial. Well, first and foremost, it's important to stay informed, read the financial news, follow market trends, and keep an eye on economic indicators. These can give you a sense of where the market might be headed. And don't hesitate to talk to your financial advisor. They can provide personalized advice based on your financial goals and risk tolerance. Knowledge is power, especially when it comes to investing. The more you know, the better equipped you'll be to make informed decisions. The good news is that even when there's uncertainty in the air, there are always opportunities to make money in the stock market. Market volatility can create buying opportunities for savvy investors. For example, when the market dips, it can be a good time to buy stocks at a discount. This strategy, known as buying the dip, allows you to purchase shares at lower prices. It's like a sale at your favorite store. Who doesn't love a good bargain? But remember, investing always comes with risks. The market can be unpredictable and prices can go down as well as up. That's why it's important to diversify your portfolio. Diversification means spreading your investments across different asset classes such as stocks, bonds, and real estate. This means spreading your money across different types of investments. By doing so, you can reduce the impact of a poor performing investment on your overall portfolio. This helps reduce your risk if one investment doesn't perform well. Diversification is like having a safety net. It can help protect your investments from market volatility. Don't put all your eggs in one basket. By diversifying, you can balance the potential for higher returns with the need to manage risk. Additionally, consider attending financial seminars or workshops. These events can provide valuable insights and strategies from experts in the field. Reading books on investing and taking notes during seminars can also enhance your understanding and help you make better investment decisions. In today's digital age, there are numerous tools and apps available to help you track your investments and stay updated on market trends. Make use of these resources to stay ahead. Finally, don't forget to discuss your investment plans with your family or partner. It's important to ensure that everyone is on the same page and understands the potential risks and rewards. With the right knowledge, strategies, and tools, you can navigate the world of investing with confidence and work towards achieving your financial goals. Remember, investing is a journey, not a sprint. Stay informed, stay diversified, and stay focused on your long-term objectives. The opportunities are out there, and with careful planning, you can make the most of them. Section 5. Beyond the indices, sector performance, and geopolitical factors. When it comes to understanding the stock market, it's not just about the big indices like the S&P 500 and Nasdaq. It's also important to look at how different sectors of the economy are performing. Sectors are like neighborhoods in a city. Some neighborhoods are trendy and attract a lot of attention, while others are more low-key. For example, the technology sector has been on fire lately, driven by companies like Apple, Microsoft, and Amazon. But other sectors like energy and financials might be facing headwinds. It's also crucial to keep an eye on geopolitical factors. These are events happening around the world that can impact the stock market, such as trade wars, political instability, or natural disasters. These events can create both risks and opportunities for investors. Section 6. The road ahead. Navigating the stock market landscape. So what's the road ahead look like for the stock market? Well, if I had a crystal ball, I'd be a very rich man. The truth is, no one knows for sure what the future holds. The stock market is inherently unpredictable. However, we can make educated guesses based on current trends, economic data, and expert analysis. The important thing is to stay informed, be prepared for volatility, and have a sound investment strategy in place. Remember, investing is a marathon, not a sprint. It's about making smart decisions over the long term and not getting spooked by short-term fluctuations. Keep your eyes on the prize, which is achieving your financial goals.